Breaking down today's record action, we have Matson Money's Mark Matson. He's going to tell us why you shouldn't focus on U.S. large caps right now. Warren Financial's Randy Warren is going to help investors prepare for what he says is going to be a volatile 2015. And Todd Horowitz, if it's Wednesday, it's got to be Todd, and it's got to be a bull day because, of course, Todd is a bear. Todd, here we go again. What do you say?
Well, you know, I'm here for hi, listen, David. I'm here for my 35th record high. It's a wonderful feeling. I'm not worried. I'm about ready to wave my white flag. But instead, I will say, what me worry?
Alfred E. Newman.
The bottom line is, there you go. The bottom line is the market is going up. It's the fourth quarter, typically bullish. I'm still bearish. I'm looking for opportunity to sell the market. The Fed Beige Book came out today. They said that everything is as expected, but if everything is as good as they say, what is preventing them from raising rates? The only thing that's going to make this market make me comfortable.
Todd, other nations' problems, but that doesn't mean that you can't be bullish about the U.S. stock market.
I'm bullish the U.S. I'm bullish America, but I'm not bullish the stock market. I think the market is way overdone here. I think we'll look back in history as this be one of the biggest bubbles we ever built, all built on paper and no real production, which we haven't seen, of course, Black Friday.
He fought the tape. He's losing on that one. We love you still, but let me get to somebody who's been bullish here, and that's Mark Matson. Do you continue to be? And we're all waiting. If we held our breath, we'd be dead by now, waiting for Todd to be right. But it's okay, Todd. We love you. Mark, do you get a sense that maybe Todd is partially right, that this is well overdone to the upside?
Well, trying to predict the future in the short term is always a loser's game. What I like to focus on is on that. And a day like this is great because it helps investors gain hope in equities again. But what I always want to help investors to focus on is, yeah, it's great when the S&P or the Dow's are at an all-time high, but they have to focus on microcap stocks and also on international stocks. We all know that we should rebalance our portfolios, buy the thing that's down, but our instincts and emotion make that very hard to do. So my lesson to investors right now is we only have about 10% of our money in the S&P, large stocks, but you have to look at those microcaps. You have to be internationally diversified. Force yourself to buy the thing that's down, not chase the thing that's up.
All right, I want to go to Randy, but I have to throw in a defense line here for Todd because Todd still makes a lot of money. He makes money by holding on to good, solid stocks that you know you can hold on to for a lifetime, preparing for the day when the market falls. That's what he's doing. But Randy, consumer stocks, a lot of people are wondering now, particularly in light of what happened over the Thanksgiving holidays and some disappointing retail numbers, whether that's the place to go. But you like Buffalo Wild Wings and Under Armour. You're right in the center of the consumer stocks. Does it concern you at all what happened over the Thanksgiving break?
No, actually, what happened over Thanksgiving break was that OPEC decided they weren't going to cut production. So with oil prices falling,
Randy, hold on. I'm talking about the miss on retail numbers. A lot of retail establishments did not do so well over Thanksgiving, and yet you're going for retail stocks. Why?
No, I think you got to pick the good ones, first of all, not just any retail stock or not just the entire sector. That's why we identified Buffalo Wild and Under Armour, trying to pick out the really the best stocks that we can find in this space, stocks that are going to do well and have done well and have a bright future ahead of them. And the fundamentals are backing those stocks up.
Those are interesting names, and Under Armour has definitely been a real winner, I think. So that's a very nice name to pick. I want to go back to Todd and back into this question in a way. Where will be the first place you will start buying when you feel that the market is appropriately priced?
I think we need a correction probably in the neighborhood of 15 to 20% before I would really look. Now, again, things can change. And as David said, I am a long-term investor. As an investor, I own equity, so I'm benefiting from what's going on in the market. But as a trader, I am not interested here at all. As a trader, I want to find the best spot to get short. But until I want to start committing new money and start growing into the market and get long as a trader, I would think we need 15 to 20% as a real solid correction. We need some fear. We need some volatility, which has been absent. The Russell has told us that there's still a lot of trouble going on here. It's basically going nowhere all year. So I want to see a nice little 15 to 20% correction. Then I'd be looking to get long here, just as I did, you know, in oil and in gold when they were down to the lower levels.
Mark, what has surprised you most about investing and trading in this quarter?
Well, the thing that really surprises me about this year in general is just how fast people forget about the rules of investing. They're really simple. Own equities long term, diversify, and then rebalance your portfolio and buy those segments that are down. Look, don't bet against the market long term. If you want to know how destructive that is, just ask Peter Schiff. Look, you have to own equities long term. Don't gamble. Don't forecast and predict in the short run. You got to own your equities over 20 or 30 years. You know, market timing increases risk, not decreases it.
What are you picking?
Because if you're betting against the market,
what are you picking now?
I gave you some examples of Papa John's and Krispy Kreme and so
Robin.
forth. Because I gave you just a little taste of some microcap stocks we own in the portfolio, but we own them not because they're great companies individually, but they're examples of small U.S. companies. Based on research by Eugene Fama, who won the Nobel Prize, small company stocks have about a 3 to 4% higher expected return than growth stocks that we're looking at today on the S&P.
By the way, you are avoiding hedge funds right now. Why?
Well, hedge funds are just a loser's bet. I mean, if you look over last year, they've only made up about 1.5%. But if you go back to 2007, looking at hedge funds as a category, they're up less than 1%. I mean, it's devastating. Also, stay away from gold. Don't speculate with that. And you got to stay away from long bonds. Huge risk in that right now.
Randy, what would you avoid right now?
I think what investors really need to be thinking about for 2015 is that volatility is going to be returning. We're going to see more corrections of that nature where it's 10 to 15%. And people need to start thinking about predictable volatility. How do I approach a predictably volatile environment? And volatility's been a bad word for investors because it always means losing money. But when you have a strategy, we've put in place a strategy that basically trades volatility options to try to offset losses in the market. So we're expecting volatility and we're expecting market pullbacks, but we can benefit from those market pullbacks in a number of different ways, by buying the bottoms, by trading the volatility options to try to offset losses in the equity side.
Yeah. And Todd, let me ask you, what are you holding on to long term? You are a long-term investor. You're not all in cash or anything at the moment. So what do you think will stand up to this downturn that you see coming?
Well, I think stocks like AT&T will hold up. Stocks like Verizon. A lot of the stocks, I'm looking for stocks that are going to pay dividend because, as Liz has pointed out many times, the market does go up 9% year over year. So I want to hold stocks that are going to compound. I don't want to get in stuff that has high risk, high beta. I'm going to look into dividend-paying stocks that are going to continue to pay money. I'm in some of the small REITs that pay big dividends. Just stuff that's going to continue to grow that I don't look at. I don't open up my statements every month. I haven't looked at a statement in 5 years. It doesn't really matter because it's a long-term hold.
Yep.
And I will use strategies over time.
And you know what? You save yourself a lot of grief when you do that as well. Thank you very much, Mark Mattson, Randy Warren, and Todd Harwitz. Good to see you.